The Vanguard S&P 500 ETF, the VOO, has become the default investment with over $866 billion in investor money and up 70% in the last 5 years. It seems like a no-brainer. But what if that safe choice is quietly costing you millions of dollars over time? What if the biggest opportunity in this market isn't inside the index? I just sold over $60,000 of my VOO position, and in this video, I'm breaking down exactly why and the 10 stocks I bought that could leave the index in the dust. Now, I'm going to tell you why I'm selling the VOO next, but let's jump right in with this first stock I bought. One of my favorites here, NRG Energy, ticker NRG. It's in the utility sector, up 330% just over the last 5 years. And what I really like about this one, not only that broad safety in the utility sector, it's going to provide dividends as well as growth, but it is tapped into that AI revolution. Okay, power is one of the biggest bottlenecks in AI. Energy does it better than any other company because one, it's got the traditional electricity generation, but it's also the largest renewable energy generator in the United States. So it's got a very big portfolio in not just some of those solar, wind power, but also nuclear energy, which is becoming the go-to source for AI. For each of these stocks, I'm going to be looking at not just those returns, but the growth and the profitability that is leading to those returns. Here with growth for energy, we can see revenue growth over the last year over year, 9.18%. That is 34% higher than the sector. So what we're looking for is companies that are generating revenue growth faster than their sector, beating their peers in the sector, and preferably as well as the revenue growth over their own 5-year average. Okay, we don't see that here with energy. Had 33% revenue growth over the last 5 years. So it is downshifting there. That's just as a function of how strong the revenue growth was. Usually you don't see 33% revenue growth for a utility company, but 10% revenue growth is still very strong for this company. Here in profitability, not as strong on a competitive basis. It is 20% gross profit. Down here to EBITDA, that's what I really like to look at. That's basically the operating margin there, that EBITDA margin. That's your operating margin. 10% there against a 36% sector median. And what this tells me is that, yes, energy isn't converting those sales into earnings and operational earnings like a lot of its peers. That's where we have to go in and see why. And what we find is energy is just reinvesting so much of that sales, so much of that revenue back into that growth. Okay, it sees the writing on the wall. This growth in AI related electricity demand. It is reinvesting to take more of that market share, especially in its nuclear facilities. So that's why we only have about a 10% EBITDA margin or operating margin here. One of the other factors we'll look at with the VOO as well as some of these stocks is those dividends. Okay, the VO used to be a good dividend stock for a lot of investors. Now it's yielding something like just 1% yield, which isn't a dividend stock in my book. So we want to look at some of these other stocks that we're getting an income from, see if they can provide a better income. This one's only about 1.2% dividend yield, so not much of a dividend stock there either, but only paying out 21% of its earnings to cover that dividend. So in your dividend stocks, that's one of the things you want to look at, a payout ratio compared to what others in the industry are paying. Here we see that energy, because it is reinvesting so much money into that growth, it's really only paying out a fraction of that, a fifth of those earnings as the dividends. It's also buying back shares, so that's good. But what we should see here is, again, after it stopped so aggressively reinvesting so much into to maintain that growth and take that market share, we're going to start seeing that operational efficiency come up, those operating margins come up, and we'll start seeing this payout ratio come up even more. We do have a 5-year growth rate of dividends, 8% growth rate a year. That is very strong. We're going to start to see that accelerate as this company shifts from that growth into operational performance, into earnings growth. And we'll get to that next stock, but it's important to understand what the VOO is, the pros, the cons, as well as why I changed my mind and am buying these 10 stocks instead. Now, the VOO is an index fund holding all the stocks in the S&P 500. That means the portfolio manager really has no say in these stocks. It's just whatever is in that index. And in this case, that's the S&P 500. Happens to be the 500 largest companies in the United States. We can see that by going to the holdings here, and we can see a breakdown of the stocks by sector first. We can see technologies, 32% of this stock. So we do have problems with diversification with the VOO, with the Vanguard VOO right now. So much of it is in tech stocks. It's basically a tech index ETF, right? In fact, we've got 5 sectors here that are just 15% of the index. So if you're looking for a broadly diversified index fund that gives you every sector, every piece of the economy, really you're not getting it here with the VOO. It's going to be one of the cons, one of the reasons why I started selling and in buying these other stocks to really create my own diversified portfolio. And scrolling down here, you see that backed up in the top 10 holdings. These top 10 stocks, just 36% of the company, so or of the index. So of the 500 stocks that this index holds, this ETF holds, all 500 of the largest companies in the United States, just 10 of them are 36 or more than a third of the portfolio. You've got Nvidia, you've got Apple, Microsoft, Amazon, a lot of these very good stocks, but it doesn't necessarily mean I want 7% of my wealth all in that one stock, all in Nvidia, or 36% just in 10 stocks. Another factor when you're looking at ETFs like this, very important, how much are you paying to hold that ETF? What you got to understand, folks, is that that portfolio manager is putting all those stocks into that group, selling it as one ETF, one stock for your convenience. You're going to pay a fee for that convenience, and that is the expense ratio. Here we see what Vanguard does better than any other index or ETF provider, that VOO with an expense ratio of just 0.03%. That is almost nothing. That is basically free, or as close to free as you can get. You can see here the median expense ratio for all ETFs is around 0.5%. That means that you're paying 0.5% of your investment to that portfolio manager each year for holding those ETFs. So we do see one of the pros of the VOO, that are really all Vanguard ETFs, is that they are so cheap to hold that they're almost free for holding these ETFs. But then we look over at dividends, and this used to be a big selling point of the Vanguard VOO, the dividend yield you got on this, the broad market dividend yield. And you can see while the overall dividend grade is an A minus, I would question that just on some of these ratings that matter most, right? 1.1% dividend yield. That is not a dividend stock or a dividend ETF in my book. You can see here the median for all ETFs is 2.7%. Okay, so that is less than half of what you get on most ETFs in general. Dividend growth rate, not bad, but not great. Not the 7, not the 8% dividend growth we saw just this with energy there before. It's not going to be anywhere near close to what we'll see with some of these other dividend stocks that I'm adding to my portfolio. But 5.4% dividend growth, that is under the median for all ETFs. Dividend growth rate, that's the trailing 12 months. The 3-year, the 5-year, not much better. All those are right around under 6% dividend growth rate. Now, investors love the VOO because it makes investing effortless. And historically, it's hard to argue with a 70% price return or that 84% total return when you include those dividends over the 5 years. That is a 13% annualized return, and you got it with just no research into individual stocks. And sure, it's taken investors on a roller coaster at times, but with exposure to all 500 stocks in that index, it's at least a little smoother than most of those individual names. Now add in an ultra low expense ratio, and it's been an easy set it and forget it investment. But then here's why I changed my mind. I sold the VOO and am buying these 10 stocks. Now, investors have been preached to about that idea of diversification for decades, and the idea itself, not having to worry about just one stock wrecking your portfolio is one thing. Then again, not making as much money isn't so great. Warren Buffett didn't build a billion-dollar portfolio buying the entire market like this VOO. His position in shares of Apple was nearly half the Berkshire portfolio at one point, and it returned over 1,480% since 2013. It's almost 3 times the 510% return on the VOO index fund. Folks, it's concentration in the right stocks that matters. In fact, the 10 stocks I bought to replace the VOO returned an average 323% just over the last 5 years. That's compared to just 84% for the index. That's not a small gap. That is life-changing money. But now, in a twist on that diversification promise, the VOO isn't nearly the safety it once was for investors. Today, more than a third of that fund is in tech and those other risky growth stocks. Now, a lot of my top 10 stocks are in tech as well, but instead of just blindly owning everything, I want my risk with the upside return that comes with it, not being buried with a 500 other stocks. And here, the income argument really doesn't hold up either. With just a 1.1% dividend yield, that's a D rating on yield and a D on that 5-year dividend growth as well. Now, if you want growth, and I buy growth, and some of the top 10 stocks on my list don't pay a dividend at all. But for the ones that do, it better be above 1% to call it a true dividend stock. Next on the list of stocks to replace the VOO, EQT Corporation, that's ticker EQT, big provider of natural gas and natural gas services here. We are seeing a giant growth in that natural gas industry, just from the needs from Europe to export natural gas to Europe, trying to wean itself off of that Russian natural gas, as well as a lot of the problems we're seeing in Iran here. The reliance on internationally on natural gas is giving a big boost to the natural gas sector or industry here in the United States. EQT, one of the largest here. We can see here with a 5-year return of 256%. Again, VOO just an 84% total return over that period, 256% right here with EQT. For growth here, we see that growth in natural gas, 62% year over year growth. I'm not saying it keeps up that growth. I don't think it's possible to keep up that kind of growth over the long period, but 62% revenue growth over the last year, absolutely blowing the industry growth of 1.4% out of the water. We see that even in forward numbers. So the expectations, forward analyst expectations for 22, 23% growth over the next year. We're seeing that growth in the natural gas industry come through here to EQT. EQT is taking market share, using that to leverage its own revenue growth up higher than even the sector median of 4% here. And profitability, one thing you don't usually see here in these high growth stocks, okay, any stock growing its revenue at 62%, you usually see it break down in profitability because they are reinvesting so much into that growth to maintain that growth. Here, on the other hand, here with EQT, you see the opposite. You see a company that's able to leverage that growth into even higher earnings. Okay, so we have gross profit here of 78%. That's going to be the income left over after paying suppliers and production, much higher than the sector median. Again, we down here to the operating margin, the EBITDA margin. That's earnings before interest, taxes, depreciation, and amortization. That is your operating margin, your core margin, your core profitability for companies. Okay, this is the operating income left over after paying not just those suppliers and production, but also all the operating expenses, the research and development, the marketing, the sales, all those other operating and staffing expenses. That's your core operating profitability. We see here 74% operating margin versus just 33%, so more than double the operating margin for the sector median. And why this is even more important, folks, this growth and the profitability, that's your clue into competitive advantages of any company. Okay, any company that can grow its sales faster than its peers, that can perform or turn those sales into earnings or more efficiently at a higher percentage than its peers, it's doing something right. It has some kind of competitive advantage where it's able to take that market share, grow faster, and convert those into income, into earnings better than other companies. You don't have to be an analyst in these stocks. You don't have to know exactly what that competitive advantage is. It helps to know if it's durable and if it's a long-term stock holding or not. But you don't know, you just look at these numbers and you know it's doing something right. Now, we're just getting started on those stocks to buy, but first, I want to highlight a special offer on the resource I'm using for research here. Now, I've used the premium access on Seeking Alpha for more than 12 years to get analysis and ideas, and more importantly, make sure I'm getting both the bull and the bear case for a stock. That way, I always know why a stock is falling, moving higher, and where it could go next. With that premium access, you're going to find pre-built stock screeners for top-rated stocks, dividend yields, and growth stocks, all updated with the most recent financial results. You're also going to be able to sit in on a company's earnings report to get that insider's view. Look for the link I'll leave in the description to try premium access risk-free for 7 days. You're also going to get an exclusive coupon for $30 off your first year, so check out that link or just scan the QR code here. Next up here, one of my favorite long-term stocks, the CBOE Global Markets, ticker CBOE. Yes, that is how you pronounce it, the CBOE instead of the CBOE, which it used to be that. It used to be CBOE because it was the Chicago Board of Options Exchange. Okay, just that exchange there in Chicago, the largest derivatives and futures exchange in the world. But since they started adding a lot of other exchanges, a lot of other assets, they've rebranded to just CBOE. Okay, so little background there. I didn't know that until just last year. I was invited to visit the SIBO and give some talks there with the Blossom Investing app. But talked to them and they said yes, it is pronounced SIBO now. A little hard to get used to. 5-year return though here, 178%. And why I like this is really the picks and shovels for the exchanges, for investors. Okay, they do own and operate that options exchange, their biggest one there, but they own a lot of other options or exchanges there for global markets. Basically, this is every trade that goes through those exchanges, you're gonna get, or that company gets a piece of those trades. Okay, gets a fee and rates for those trades. It's a great picks and shovels way to actually benefit when the market falls as well. When stocks fall, when the stock market falls, there you see more trading, you see more volatility. That's where the CBOE really shines. That CBOE with their options exchange and the futures, you see a lot more trading in options, in futures to cover to hedge a lot of that downside exposure. So you see a lot of activity here in in this company's assets. And here for revenue growth, you would think with a company in an industry that is hundreds of years old, these exchanges, these stock market exchanges, the options exchange, been around forever. You'd think you'd have a little bit lower, have to be happy with a little bit lower sales growth. But we see here 15% sales growth year over year for the SIBO there. That is almost double its 5-year average, as well as double the sector average or sector median. So here we see a company that is not only growing almost twice as fast as the sector itself, but also twice as fast as its own 5-year average. So getting faster, getting stronger revenue growth there. Here in the profitability, we start seeing that it is reinvesting more to maintain that growth, to increase its revenue growth. That is coming at the expense of some profitability. So we do see here gross profit of 51% is under the sector median. It's still over its own 5-year average. So that's good. It is getting more profitable compared to itself. We do start seeing though it improving here. Down once you get down to the operating margin, this EBITDA margin, it is 34% operating profitability. That is above the sector median and as well as above its own 5-year average. So very interesting that it is actually down, just 51% versus the sector median of gross profit profitability or gross profit margin there. But by the time we get down to operating expenses, it is more profitable than the sector. What that tells me is it might not have quite the power over suppliers or the production costs there that that is converting into gross margin. So a little weakness there, but on an operational level. So the way management is guiding this company, management and operating expenses, it is very profitable, even more profitable than its peers. So 34% operating margin there, very strong for SIBO Global Markets. Company does pay out a dividend stock, but again, not really a dividend stock in my book. Just 1% dividend yield, pretty much on par. All three of those pretty much on par with the VOO. So by selling the VOO and buying these three stocks, you're not losing anything as far as dividends. You're still getting about a 1% yield, not much. The payout ratio here of just 25%, very low. 5-year growth rate has grown at dividends by 11.5% a year over the last 5. So that is very strong. If that keeps on going, it is going to be increasing this dividend yield quite a bit, and you're going to be making a lot more money. Next stock here is the Williams Company, ticker WMB. It's a pipeline company, so basically an energy company that makes its money off transporting oil and natural gas through its pipelines. And what I like about this is not only that energy trend and that safety and the dividends in energy that we have, and the 223% return over the last 5 years. What I really like about this is that it doesn't necessarily depend on high energy prices. Okay, right now with the war in Iran, we've seen energy explode higher. That's not always going to be the case. Okay, supply demand fundamentals for oil is not favorable. probably only about 70, maybe $75 per barrel at best over the next year once we get through this Iran conflict. But Williams is safer than that in the energy sector, okay? Because Williams and all these other pipeline companies, they make their money on a fee basis. The volume of energy, the volume of oil, the volume of natural gas that passes through the pipelines, that's how it makes money. So it makes money on a fee basis, not necessarily tied to the oil prices. Now, oil prices up and down is going to affect this stock, but again, a little bit safer than some of those oil explorers like Chevron, like Exxon, like Diamondback Energy. Here, looking at the growth for the company, what we really like to see, okay, a company that is not only growing revenue faster than the sector, but also faster than itself over the last 5 years. Here we see 10% year-over-year revenue growth for the company. That is a 600% higher than the sector median. Okay, 8% average over the last 5 years, so it's 25% better than its own average. This is a company not only just blowing the doors off the sector median as far as revenue growth, but also getting faster compared to itself over the last 5 years. Really like that. Really shows that Williams is doing something, has some kind of a competitive advantage, that it's able to take that market share, grow revenue so much faster than its peers, that it is able to take that and then turn it into profits for investors. And here, looking at profitability, we have a gross margin, an EBITDA margin, and a net income margin. So all three of those top margins, those top profitability metrics there above the sector median, as well as above the company's own. So again, not only is this company growing its revenue faster than it has over the past, faster than the sector, it's turning that revenue into earnings at a faster pace and more efficiently than itself as well as the sector. 62% gross margin there, above the 46% above the sector median. Here, all the way down to net income. Now, this is your bottom line net income, your net earnings. The profitability of the company, 22%, more than twice what the sector median is at 8.3%, even above the sector's or the company's 5-year average of about 20%. So very strong operating efficiency, operating profitability for this company. And here in dividends, finally, we get a stock that is a little bit more closer to a dividend stock in my book. 2.9% dividend yield. Not quite the high yield that we want to see, but it is a hell of a lot better than that 1.1% dividend yield from the VOO or from some of these other stocks. 5-year growth rate of 4.7%, payout ratio of 95%. So we would want to look into that. Actually, that's a little bit skewed here. You cannot use this payout ratio for these master limited partnerships, for these pipeline companies, because they have so much depreciation on their on their income statement, so much depreciation, which is not a cash charge, that it makes their earnings look artificially low. It makes this payout ratio look artificially high. I know it's a lot of accounting. I nerd out on that stuff. You don't necessarily have to understand all of it. Just know that with these MLPs, these pipeline companies, you can't really look at the payout ratio and say, wow, that's really high. It's a much lower cash flow ratio with their dividend there, but very strong 2.9% dividend yield for Williams, ticker WMB. Fifth stock here on the list, one of my favorites, Palo Alto Networks, ticker PANW. All you out there in the nation know I am a big believer in cybersecurity. AI, artificial intelligence, increasing the attack surface that hackers are using to get into companies. That is gonna see a surge in demand for these cybersecurity stocks. PANW, Palo Alto Networks, one of the largest in the space, and really got a great portfolio of assets across all the different segments of cybersecurity. Here, 5-year average, 219%. We can see some weakness here this year as that software apocalypse has started this year since October. A lot of people are scared that AI is going to replace a lot of these software companies, cybersecurity companies. What we're actually seeing, in fact, is that AI is increasing the demand for a lot of these, especially cybersecurity. Palo Alto Networks now at a very strong, very good valuation here, down at $168 per share. Growth here a little bit slower than some of these, and not what you would expect from a strong theme like cybersecurity. But again, Palo Alto, it's just so large on a market cap basis that it is hard to turn that ship 15% revenue growth year over year. Now, what we will see with Palo Alto is a much higher profitability. Okay, compare that to some of those other cybersecurity stocks that you see, CrowdStrike Holdings, Zscaler, also good stocks in that space, but very much less profitable than Palo Alto. What we see is Palo Alto is not growing sales quite as fast as some of the others, but is converting those sales at a much better pace into its earnings for investors. So we're going to see that helps to bring this stock back on a list, back on a lot of screeners there. 15% revenue growth. It is lower than the 22% 5-year average, but almost still 52% above the sector median. So still doing very much better than the other stocks in that sector, even if it's a little bit slower than that 5-year average. I believe with some of the new acquisitions this company has made, they are going to boost that revenue growth higher, back up to maybe even 20% revenue growth over the next couple of years as we do start seeing AI increase the demand for cybersecurity services. And again, here looking at profitability, this is where we see Palo Alto really shine here. 73% gross profit margin. That is a 50% above the sector median there, and just a little bit above Palo Alto's own 5-year average. We get down here to EBITDA margin. Again, my favorite profitability statistic, that EBITDA margin, or that operating margin, operating profitability there. 15% for Palo Alto Networks. Again, if you look at other cybersecurity companies, you're going to see negative EBITDA margin because they are reinvesting so much of their money in for that growth. That's not necessarily a bad thing, a theme, a cybersecurity growing so fast. You want to be reinvesting for that growth and growing the company sales. But sometimes you just want those earnings as well. So what I like about this is this Palo Alto. I can balance that trade-off between higher sales and lower profitability with Palo Alto. Here with a little bit lower sales growth, but much higher EBITDA margin, much higher profitability. Really works well when you're holding this plus CrowdStrike plus Zscaler, some of those lower profitability companies. We are just halfway through the list of stocks, with my biggest investment still to come, but understand, this doesn't mean you have to totally ditch that Vanguard VOO. It's still an easy way to get exposure to all 500 of those stocks in the S&P 500 index. And what changed for me was I realized I could do better with it, maybe a little lower exposure to all 500 and put more of that into these for that upside. Folks, stock market volatility has surged this year, and that means it is a stock picker's market where just doing some basic research can get you better returns outside the index. Back to our list though, and Walmart, ticker WMT, one of my favorite stocks outside of that growth and tech theme. So what we want here is a little bit more diversification, something outside of the tech stocks to smooth out the portfolio just in case we get some kind of a tech sell-off or a tech crash. Walmart is always going to be there for you. The largest retailer there in the world, maybe second to Amazon now, depending on when you take that measure, but a huge retailer and a lot of levers to play. Okay, I think the lowering of food tariffs over the last year is really going to boost the margins for the profitability for this company. It has some great picks in its own brands there. A lot of the brands you see at Walmart are run by Walmart itself, its own brands. It's starting to give those preference on shelf space. So it's really taking a lot of market share away from some of those other consumer staples companies. Why we've seen a lot of the stocks like Heinz, like Procter & Gamble, a lot of those stocks down over the last year because Walmart is being very aggressive with its own brands, giving those preference on shelf space. It's also coming into shopping on GPT. It's going to be able to leverage that as well as its own recent acquisitions that are really boosting it in the advertising space. Here we can see 175% return over the last 5 years. I believe it just keeps on going with that kind of a return, leveraging its size and some of these competitive advantages to keep performing for investors. Now, of course, with a very mature industry like retail, like groceries, a lot of the segments that Walmart runs, you're not going to get that double-digit growth, but you do still get very strong competitive growth here with Walmart. Revenue growth of 4.7% over the last year. That is more than double the sector median. So even though it's only growing sales by about 5% a year, that is still double what its peers are doing. That really tells you Walmart is using some of those advantages, using some of those levers that I talked about to double the revenue growth, to take some of that market share. Again, a lot of the consumer staple stocks, just look in there. Look at what some of those stocks, Campbell's Soup, look at Heinz, look at some of those other consumer staple stocks, what they've done over the last year compared to Walmart. And you see Walmart is growing its revenue so much faster because it is taking that shelf space. Now, we do see a little bit lower profitability here with Walmart. We see 25% gross profit margin versus 35% median. Again, once you get down here to that EBITDA margin, just 6% operating margin, that is about half of what the sector median is. I do believe a lot of this is that reinvesting for that future growth, why it's able to double the revenue growth of the sector median. Eventually it's going to turn, it's going to flip a switch, it's going to become more profitable. I do believe we start hearing things about maybe layoffs at the company, maybe getting more leaner, more efficient, just because this EBITDA margin is quite a bit lower. Over this next year, I do believe the management is going to start talking about that efficiency, that profitability, boosting that. That's going to go a long way to converting those sales into earnings for investors. One of my favorite stocks here with some amazing growth, Broadcom Inc., ticker AVGO. This stock is up over 572% over the last 5 years. I believe we've got even the best to come on this data center stock. This is probably, next to NVIDIA, the best stock for that data center infrastructure build out. Okay, we've got the top 5 hyperscalers, just Meta. We've got Amazon, Microsoft, Google alone spending $700 billion this year building more data centers so they can have more AI compute. No other company besides maybe NVIDIA has as much inputs, as much components that go into a data center. Okay, Broadcom, AVGO, not only has the chips, the accelerator chips that go in there, it also has the networking that is a big bottleneck for AI right now. Getting that information from storage into the chips, back and forth, and then out to users, that networking, that is a big advantage of Broadcom. It's leveraging that for this 500% growth or return over the past 5 years. And that's the competitive advantage we're going to see take this stock higher. You see that in the statistics here for growth over the last year, 25% revenue growth. That is more than double the sector median. Okay, 25% versus 10%. That is 150% more than the sector median revenue growth. It's more than the AVGO's at 5-year average of 20%. So not only growing faster than the sector, growing faster than itself, leveraging those advantages to take more market share. Look at this forward revenue growth. What analysts are expecting 44% this year. So it is expected to get 44% revenue growth over the next year, increase that growth and increase that market share. And one of the things I really like about Broadcom is that it's not only growing that revenue, it is investing in the future, investing for that growth, but it's doing it smartly. It is still very profitable and converting those sales into earnings. It's a big problem you see with a lot of these other companies that we're going to look at. A lot of the other companies in that AI space, they are growing revenue very quickly, but they're spending so much. They're reinvesting so much of those sales back into the company for growth that they have almost no earnings left over, no earnings growth left over when it all comes down to it. You see that, you do not see that here in Broadcom. You see gross profit of 76%, down here operating margin, EBITDA margin of 54%. That is almost 5 times. That is 4 times the sector median and above its own 5-year average. So not only being able to grow sales very quickly, but also converting those sales into profits. That is a very good clue into the competitive advantages of this company, that it is taking that market share. It's doing something where it's able to take that market share from its peers, and it's not having to reinvest so aggressively that it doesn't have any earnings growth. Okay, it is able to do that and still be very profitable. Balancing those tech stocks out with one of my favorite stocks in healthcare here, AbbVie Inc., ticker ABBV. Very important. Again, if you're ditching those index funds, like the VOO, that you still do get some exposure to these other sectors. Healthcare, very important here. Obviously, healthcare going to hold up in a recession. People aren't canceling their medications. I can't go off my cholesterol medication just because we hit a recession, right? I have to keep taking that every single night, okay? That's why you have AbbVie. That's why you have some of these drug makers. This stock up 99%, almost 100% over the past 5 years. Slow, but very steady and stable. This is the stock that you want to hold just in case we get a tech sell-off and some of those other tech stocks like Broadcom, like some of the other stocks in cybersecurity do fall. You want AbbVie to smooth out your portfolio and still keep those returns going. Looking at growth for this stock, it is not quite a slam dunk, though it does have some very good positives here. 8.5% revenue growth over the last year. That is 23% higher than the sector median. So very important. It is still growing sales faster than the sector, faster than its peers. that does tell you that it has something. It's doing something right to be able to take that market share, grow faster. That is slower than the 5-year average. Now, with these drug maker stocks, of course, it is always about the pipeline, those FDA trials and tests of when those drugs come out, which ones are the blockbusters, and how that works out. So, very much more a lumpy revenue growth here for these drug maker stocks. But AbbVie, one of the largest, always has a full pipeline of drugs coming onto market to replace the ones that go off and get competition from those generics. So any company, any drug maker that can regularly grow faster than the sector than the sector median, that tells you that they've got really a competitive advantage in their pipeline of drugs, in their research and development of that pipeline to really keep that pipeline growing. And what AbbVie fails in growth, it makes up for in profitability here. Gross profit is 71%. That is 20% higher than the sector median. You get down here to EBITDA margin, even more important than the gross margin, because I like the EBITDA margin, that operating margin, because it includes the gross profit margin as well, but it also includes all the operating costs that the company has, how efficiently it is after paying not just the suppliers and production that you have here in the gross profit margin, but also those operating costs, the research and development, which is so important for a drug maker. Also, all the sales and marketing, also important for a drug maker, for a pharmaceutical company there. It wraps all of that into just one margin, into one profitability statistic there with the EBITDA or operating margin. 47% profitability there. It's almost 4 times, almost 5 times more profitable than the sector median. Okay. So, and it's very close to its 5-year average. So, no better, no worse there. Probably my favorite stock in that cybersecurity space. Again, my favorite theme over the next 3, 5, even 10 years, cybersecurity. We see average cybersecurity spending up 12% a year on forecast. I believe that ramps up with AI, with the AI threat here. And CrowdStrike Holdings, bar none, the leader in cybersecurity with its Falcon platform. Okay, really moving into AI cybersecurity as well, even more than Palo Alto. But I still do like Palo Alto, as we talked about before, for its kind of balance on that profitability and growth. Here with CrowdStrike Holdings, ticker CRWD, 117% return over the last 5 years. Just like we saw with Palo Alto, though, suffering a little bit, coming down a little bit since last October in that software apocalypse that is actually a buying opportunity. What we saw, we saw Anthropic releasing some of those Claude models that people worried that maybe could do some cybersecurity stuff, could write a lot of cybersecurity code, but we're actually seeing AI increase the attack surface or expand the attack surface, hallucinate just as much as it ever did. And I guarantee you, no, folks, no company is rushing to replace their cybersecurity infrastructure in their company with some kind of AI model that could just wreck it and delete the entire infrastructure in a heartbeat. Here in the growth for CrowdStrike, we're going to see that balance that we talked about with Palo Alto Networks in this theme of cybersecurity. We do see 21% revenue growth over the last year, 22% expected over this next year. Both of those double the sector median. Not quite as good as the 5-year average, so coming down a little bit. When you have a company growing so fast over the last 5 years, it is bound to come down a little bit, but still operating at double the revenue growth as its competition. But then here in profitability, we see what I was talking about. Okay, still very strong gross profit margin, but once you get down here to the EBITDA margin, after all that R&D costs, after all the other staffing and the marketing and all those other operational expenses, we actually have a negative EBITDA margin. Okay, it is losing money on that operating basis. Not necessarily a bad thing, just because it is growing so much faster. It is plowing all of that money back into growth, and we're eventually going to see it trigger that pivot back into profitability. It's going to be a big inflection point for the stock, and it's take the stock much higher once they do start kind of producing those earnings from those sales. But right now, negative operating margin, negative EBITDA margin. That's again why I like to kind of balance this with some of those other stocks in cybersecurity, like Palo Alto Networks, like Fortinet, ticker FTNT. Both of those, a very strong profitability, maybe a little bit lower sales growth, but strong profitability on those. So with some of these other stocks, cybersecurity stocks, then it really creates a great cybersecurity portfolio that you can hold and really take advantage of the entire theme, that growth theme in cybersecurity. And Nation, you knew I couldn't pass up Super Microcomputer, ticker SMCI, up 683% over the last 5 years. Yes, it has been a roller coaster over the last couple of years. It is down now right around $30 per share. A great value opportunity, great opportunity to buy the dip in this stock. But this stock is the leader in AI servers. Okay, what most people don't understand, if you look at the supply chain for AI infrastructure for those data centers, you've got GPUs, you got the chips from NVIDIA, from AMD going into these data centers, millions of those chips. You can't just throw them on the floor. They have to be put in a server. Okay, the server is like the brains that hold the neurons, which are those chips in a data center. And that those servers, nobody does it better than SMCI. Okay, those AI enabled servers, SMCI has 22 up to a third, up to 30% of the market share for that, because they are so much better than any of their competitors, including Dell, including HPE, including Foxconn. No other can do servers like Supermicrocomputer. You see that competitive advantage here in this growth, 35% revenue growth year over year. That is about 3 times more than the sector median. It is a little bit lower than the 5-year average, but it's still very strong. 48% forward growth. Okay, management has affirmed its guidance. Analysts expecting 48% revenue growth for this year. That is higher than the 5-year average. So it is getting back up into that 5-year average of growth that we've seen. Very strong sales growth as it takes advantage of this growth in the AI data center build out to really take that server market share. But then the biggest argument the bears have here is the profitability in this stock. In this stock, like a lot of the other AI stocks that we've seen, they are investing so much of those sales into growth, back into the company for growth to take more of that market share. There is almost no earnings growth here. Okay, so once we get down to operating margin here, EBITDA margin, just 3.9%. Very weak operating margin. Again, it's not because this company has a problem in that, it's just that it is reinvesting everything it can into that growth, trying to take that server growth. Okay, $700 billion in infrastructure, AI infrastructure spending this year alone, just from 4 companies. There is an immense amount of money going into AI-powered servers. SMCI wants to be the leader in those servers, wants a third of that market share. So it's investing, it's lowering its prices on those servers. It's reinvesting in R&D and for growth. So that's why it doesn't have the profitability that you see in a lot of other companies. I'm willing to take a pass on profitability for now. Eventually, it's going to pivot. It's going to raise its prices on its servers. It's going to spend less in that marketing and the sales and the R&D. You're going to see a boost to the earnings here, and you're going to see this stock really take off. Use the link in the description and try Seeking Alpha Premium risk-free for 7 days. Plus, get a $30 discount to your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.